So for this exercise, we're going to actually go through a set of transactions regarding inventory, and we're going to record it from two perspectives. The first perspective is we're going to record it using the periodic inventory system, or perpetual inventory system, sorry. And the second is we're going to go back to the question and actually do the set of entries using the perpetual inventory system versus the periodic inventory system. So let's try the first transaction. So the first transaction, they purchased merchandise on account from a company called Micron at a cost of $65,000, and the term is net 1%, 15 days, net 30. And it's called FOB shipping point. FOB shipping point. So we're going to take a look at the first perspective under perpetual. And then we're going to actually do the same set of entries under periodic. And the reason why we're doing this side by side is to show you the difference between the two methods of accounting for inventory. So on October 1st, they purchased merchandise on account. So under the perpetual, we're going to debit inventory, $65,000, credit accounts payable, $65,000, because it says on account, and the cost is $65,000, and the term is net 30, 1/15. That means that if they pay within 15 days from October 1st, they get a 15% discount. Otherwise, it's all payable in 30 days. Now, this is called FOB shipping point. Now, it's important to note the shipping terms because that will dictate who pays for the shipping cost. In fact, on October 1st, the shipping freight charges of $2,000 was paid by the appropriate party. In this case, because it's FOB shipping point, the buyer is responsible to pay for the shipping. And in this case, the buyer would be the company. So you would debit inventory for the shipping charge and credit cash. Now, let's take a look at it from the periodic inventory system. Under the periodic inventory system, when we record purchase of inventory, it goes to a separate account called purchases. So in this case, when we buy the inventory on October 1st, we're going to debit purchases, $65,000, and credit accounts payable, $65,000. But under perpetual, everything goes to inventory. Now, on October 1st, we actually paid for the shipping. And in this case, under perpetual, we debit inventory. So everything goes into inventory. Whereas for periodic, we're going to debit an account called freight in. And freight in is one of those accounts that gets added to purchases to determine net purchased. And we're going to credit cash. Now, on October 5th, what happens? They returned $7,000 worth of damaged goods that were purchased on October 1st. So for number 3, when you return, you're going to debit accounts payable and credit inventory. And that one is $7,000. Under the periodic inventory system, we would debit accounts payable, $7,000, But instead of crediting purchases, we're going to credit an account called purchases, returns, and allowance. It's a contra account. And again, freight in is an account that needs to be added with purchases, and purchase, returns, and allowance should be deducted from purchases to get to what we call net purchase. So you'll see that under periodic inventory system, we have multiple different accounts to track certain activities, whereas perpetual, everything goes to inventory. Now, on October the 8th, the fourth journal entry, so this is October 5th, October the 8th, we actually sold the remaining inventory to a customer called Gudant Corporations for $90,000. So this is an actual sale. So the entry for October the 8th is debit accounts receivable $90,000 and credit sales $90,000. And the net term of this one is 210 net 30, and it's FOB destination. And that means that the seller is responsible for paying the freight cost and ensuring that the goods travel safely in good condition at the place of the customer's place of business. Now, the same entry happens on October the 8th. So we're going to debit accounts receivable, credit sales. Now, here's the difference. Under perpetual, you are required to record the corresponding cost of goods sold. So in this case, we need to determine the cost of goods sold. So we're going to debit cost of goods sold for how much? Well, first of all, we paid $65,000 for those goods, plus the shipping cost of $2,000 minus the return. So this is entry number 1, number 2, and number 3, to give us a total of $60,000. And we're going to credit inventory, because we need to take it out of inventory. So under the perpetual inventory system, we're constantly updating the amount that should be in our inventory, left in our inventory after we sell a whole bunch of products. But under the periodic inventory system, there is no entry at the date of sale. The cost of goods sold is only recorded once each operating period. So at each reporting date, the only way to determine the cost of goods sold under the periodic inventory system is to actually do a physical count. We need to determine what is left in our inventory, and then that will help us determine what was sold. So if you remember the equation, right? Beginning inventory plus purchases, in this case we're calling net purchases, to give us goods available for sale. So gas. And then we either have ending inventory or cost of goods sold. So the way it works under the periodic inventory system, everything we buy goes into purchases. So we know that this is purchases plus freight in less purchases, discounts, and less purchases, returns, and allowance. These are what makes up purchases. We saw that in the previous videos. So every time we buy, we're only recording it at the various accounts related to purchases. And the only time we ever record the cost of goods sold under the periodic inventory system is that we have to actually physically determine what is left in ending inventory, subtract that from goods available for sale to give us cost of goods sold. So that's why in this transaction, when we actually sold $90,000 worth of goods, under the periodic inventory system, there's no entry at date of sale. Cost of goods sold is only recorded at end of period. Whereas for number 4, under the perpetual inventory system, we have to keep track of what the per unit cost is for these goods, and then we record the cost of goods sold when sold. Okay, so let's move on to entry number 5. Entry number 5, again, we're going to split this into half. This is perpetual, periodic. For entry number 5, they had a freight charge of $3,000. Now, because it's a freight charge, it was freight related to the shipping of those goods to our customer. Because the term was FOB destination, it is the company's expense. And of course, we need to debit freight out. And by the way, this is part of selling and admin expenses, not cost of goods sold. And we're going to credit, in this case, we're going to assume it was paid out, cash. And under the perpetual periodic inventory, it's the same entry as well. Okay. Now, number 6. This, by the way, was on October the 8th, right? Number 6 is October the 9th. The customer that we just sold the product on October the 8th returned some of the purchases, some of the merchandise that they purchased for $4,000 credit. So this is a sales return. $4,000 credit. The merchandise, the original cost of that merchandise is $2,400 and was returned to inventory. So on October the 9th, we need to record the sales returns and allowance. So we're going to debit sales returns and allowance. $4,000. Credit accounts receivable because it's no longer collectible. And by the way, it's the same entry on their perpetual inventory system. But we also need to update our inventory, don't we? So debit inventory, credit cost of goods sold. I'm using the short form as COG. And that is $2,400, the original cost. And here, again, there's no entry because we only record the cost of goods sold at the end of the accounting period. Now, for number 7, we're dealing with October 12th. They purchased office supplies for $5,000 cash. So here, the entry is debit supplies and credit cash. Now, there's a couple of options. If you think you're going to utilize the supplies within the operating month, then you expense it. Or what companies normally do when they buy supplies in bulk, they would first record it as an asset called supplies, and then they would determine how much supplies were left at the end of the operating period. So let's say we only consumed 4,000, so there's 1,000 supplies left. You would have a secondary entry at the end of the accounting period to reflect the supplies expense, the ones that were used, consumed. So you need to expense that. But let's assume that that sits in inventory, supplies inventory. And of course, under the perpetual periodic inventory system, this is the same. Okay, so what happens on the 8th? So again, we're going to have two columns here, periodic, perpetual. So for entry number 8, they paid the balance owing. To supplier. Now, how much did they owe? Well, remember they originally purchased $65,000. And if you recall, we returned $7,000 worth of merchandise to give us the total of $58,000. Now, when was this transaction? This happens to be on October 14th. If you remember, this was the invoice on October 1st, and they were giving us 15 days, and we get 1% discount. Because this happens on the 14th, which is less than 15 days, we qualify for the discount. So we're going to calculate the 1% discount. This is called cash discount or early payment discount. And that gives us $580. So the entry is going to be debit accounts payable for the $58,000, because that's how much we have balance owing. Remember, we originally bought $65,000 and we returned $7,000 on the 5th of October. So here we're going to debit accounts payable. We're going to credit cash for the net amount because we didn't have to pay them, right? For the full entire amount because we got a discount. And we're going to credit inventory. Remember, everything goes related, anything related to a purchase of inventory, whether it's a purchase, a discount, a return, all goes to inventory. Now, under the perpetual inventory system, the debit to account, so the calculation is the same. The debit to accounts payable is the same. The credit to cash is the same. But the credit for the discount should go into purchase discount. Again, a different account completely. Now, on October 15th, entry number 9, they bought inventory, purchased merchandise for $7,500 cash. So the entry is debit inventory, credit cash, and in the periodic inventory system, it's debit purchases, right? And credit cash. You can start to get a sense of what the differences are in the two methods. Now, on number 10, what happens in October 16th, we received the balance from our customers, right? So received payment from customer. So how much did our customer owe us? So first of all, we sold we sold it on 90,000. We gave them a 2% discount if they pay within 10 days. If you remember back, that was entry number 4. And then we saw that in entry number 6, October 9th, there was a return of 4,000. Okay? So we know that we sold, so sale was 90. There was sales, returns, and allowance was 4,000. So we have a net of 86,000. Now, did the customer qualify for the discount? We sold it on October the 8th, and they had 10 days. And of course, this is below 10 days, so they are qualified for a discount. And the discount that we were offering them is 2%. Early payment discount, right? Or cash discount. And that 2% is $17.20. So our entry at the date that we collected from our customers is going to be debit cash for 86 minus 1720. So that is 84,280. We are going to debit sales, returns, discounts, actually in this case, sales discounts, and that's the 1720 that we just calculated, and credit accounts receivable for 86,000. Now, what's the entry under the perpetual? It's the same. Our periodic is the same. And it's the same calculation as well. Okay? Now, entry number 11. Entry number 11, what happened? They purchased, on October 20th, they purchased equipment, delivery equipment, for $45,000. Okay, that's a capital asset. So we're going to debit delivery equipment. It's an asset. For $45,000, we're going to credit on account, which means that we have to set up some sort of liability, so accounts payable, $45,000. And of course, it's the same under the periodic inventory system. Remember, the only difference between the two is the accounting for inventory. So in a case of buying a capital asset, it would be the same. Number 12. It says that we sold merchandise for $30,000 to another customer. So sale, $30,000 to another customer, and we gave them a 210, net 30, and it's FOB shipping point. And the cost, so the sale price, and the cost for the same goods was $18,000. So, having said that, the entry under the perpetual is we're going to debit accounts receivable because it's on account, $30,000. Credit sales, $30,000. Now, remember, we need to update the cost of goods sold because that's the whole thing about perpetual, isn't it? So we're going to debit cost of goods sold, credit inventory. Now, under the periodic inventory system, this will be the same. And of course, there'll be no entry. And we only have to worry about that entry upon the actual sale itself. Okay? Or the actual, sorry, the inventory count. And finally, on October 20, this is October 28th, by the way. On October 28th, freight charge of $1,000 was paid. By the appropriate party. Now, who paid for this freight? If this was FOB shipping point, and we're selling it at FOB shipping point, it means that the customer paid for that shipping charge because they would have been responsible to hire a freight company to pick up the goods because we're only responsible at the shipping point. So in this case, there would be no entry from the seller's perspective, and again, this would be the same as well. So there's a couple of learning objectives here. As we can see from all of these transactions, under periodic inventory system, we do not record the cost of goods sold at each sale date. We only record the cost of goods sold at the end of the accounting period when we physically count the inventory. Because the only way we can figure out the cost of goods sold is we need to determine how many units remain at the end of the accounting period. Take that, whatever that value is, subtract it from the goods available for sale to determine the cost of goods sold. That entry only happens at the end of the accounting period. Under the perpetual inventory system, that entry actually gets recorded each period. So every time there's a sale, we also have to reflect the cost of goods sold, which means that we have to always constantly determine what is the value of that inventory at each sale, at each purchase and each sale, so that we can update and record a cost of goods sold appropriately. Thank you.